Hello everyone, welcome back. In this video, we are going to discuss about the Dow Theory. Dow Theory came from Charles H. Dow. He started Dow Jones Financial News Services. He was also the founder of Wall Street Journal and the first editor of this. He is known as the father of modern technical analysis, and he was the first one to create the index, and the index is known as Dow Jones Industrial Average. And whatever he summarized about the market, that took a structural shape, and that was known as Dow Theory later. But the Dow Theory name didn't come from Charles H. Dow. It was coined by A.C. Nielsen, and later William Peter Hamilton made significant contribution in the concepts of the Dow Theory, and Robert Rhea also wrote a book named Dow Theory, which became quite famous. So the Dow Theory is about structuring the market behavior and the price action of the market in form of 6 tenets. We will go into them one by one. So in this video, we are going to discuss about the first tenet. The first tenet of Dow Theory tells us that averages discount everything except the act of God. Now, what is the average? Probably in this tenet, it is being referred to the Dow Jones Industrial Average. That is the leading stock market index of the United States of America. In India, we have 2 major indices. First one is the Nifty of NSE and the Sensex of BSE. There are a host of other sectoral indices also, like banking index, the IT index, etc. And also there are indices on the mid cap or small cap stocks also. But when we are talking about the averages, we are referring to the broader indices like something called Nifty or the S&P 500 in the context of USA. Now, when we are talking about an index, whatever the price action of the index is, that takes into account all the financial and social and political parameters of a country. Now, suppose we are talking about India and we are talking about Nifty. Now, whatever the corporate profitability in India is, what is the corporate profitability growth rate in future, and also what are the macroeconomic parameters like inflation, the interest rate, the overall demand and supply, the overall different sectors that are into the economy and that are growing or slowing down, or the social and political stability of the country, or the forex reserve, or the current account deficit, the fiscal deficits of the government. So everything that can actually impact the price movement of the stocks, that is priced in within a broader index. We are not talking about a particular stock, because when we are talking about a particular stock, some surprise moves, surprise corporate actions, surprise profitability, a product innovation can take place. But when we are talking about a broader index in a general sense, we can be sure that whatever is the information that is available and whatever the future information that can be perceived today is incorporated into the price movement of the index. And that is about this tenet. And it says that the averages discount everything except the act of God. Now, what are the act of gods? An earthquake, a tsunami, or a volcanic eruption, or a flood, or a drought. So this can't be actually predicted beforehand. So apart from these, all the financial and social and political and geopolitical aspects of that can impact the movement of stock prices, that is actually reflected into the price action of the index. Now, this tenet goes on to actually define an up and down trend also. What is an uptrend? Dow defines an uptrend in a way where the prices would be forming consecutive higher highs and higher lows. So the high that is formed after the previous high is higher than the previous high. Similarly is the low. In a downtrend, completely opposite. A sequence of lower highs and lower lows. So when we have this higher high and higher low, we are in an uptrend, and when we are having a lower high and lower low, we are in a downtrend. And until and unless there is actually trend reversal, that is the sequence of higher high and higher low is broken, we can't say that the higher high, higher low or the uptrend is broken and there is a trend reversal. Similarly, in a downtrend, as long as there is consecutive lower highs and lower low and we don't find a higher high actually compared to the last high or higher low compared to the last low, we can't say that the trend has actually reversed. In certain situation, we will find that the market is providing in a situation where a high is forming, we get two consecutive higher highs but not two consecutive higher lows. Then there is no trend, we can't define a trend. Then it is more of a consolidation, like price movement within a small range. But when we have a defined trend, we will assume that the trend would actually persist until and unless we see a trend reversal by changing the sequence. Now let us look at this concept with the Nifty chart that we are going to show you now. Here we are looking at the Nifty daily chart in the investing.com web portal. Now let us focus in the chart. Here during this period of 2014 and before that, we were seeing in the market that series of higher highs and higher lows, higher highs, higher lows. Now then a downtrend started, and actually the sequence of higher highs and higher lows were violated around this point. And once this was there, as we could see that a sequence of lower highs, this high was lower than this high, this high was lower than this high, this high was lower than this high. So a sequence of lower highs and lower low started. So this was a downtrend. And then we can see that, and then we can see around here the sequence of lower lows and lower highs were violated. This was a significant low which was higher than the previous low. Then this low was again higher than this low was higher than this low. So again an uptrend took place, and then again a downtrend, consecutive highs lower than previous highs and consecutive lows lower than previous lows took place. This downtrend was again, the sequence was broken around this significant low was higher than this low, and then we see a long series of higher highs and higher lows taking place in the market. So this is all about tenant 1. Here we can see that the sequence of higher high and higher low gives us the indication of an uptrend, and the sequence of lower high and lower low are indicative of a downtrend, and the trend reversal happens when the sequence get violated. So this was all about the first tenet of the Dow theory that we had discussed, and the next video we will cover the second tenet of the Dow theory. Thank you for watching.